Hi, today I want to talk to you about what is asset allocation. Asset allocation is a fancy term. It basically means how much do you have in stocks and how much do you have in bonds. If somebody were to say you have a 60-40 portfolio, that would basically mean that you have 60% in stocks and 40% in bonds. Or an 80-20 portfolio would be 80% in stocks and 20% in bonds. The asset allocation can be broken down further by the types of stocks you have and the types of bonds you have. So in general, if you have 100% in stocks in your portfolio, somebody would classify you as aggressive. If you have more bonds in your portfolio, you'd be less aggressive or more conservative. So if you have 100% in stocks, you're looking for higher long-term growth rates, but you can be subject to more volatility based on different world events. So right now we're in the middle of the COVID-19 pandemic, where stock prices have fallen quite a bit and bonds have really kind of steadied the portfolio. But over time, as stocks recover and as things change, stocks should have a pretty good long-term growth rate as companies recover. There's different types of stocks. There's large cap value, there's large cap growth, there's small cap, there's international, there's emerging markets. So when you think about these different things or hear these different terms, basically what they mean is with large cap value, you're thinking about things like Berkshire Hathaway, JP Morgan, Johnson & Johnson, Procter & Gamble, Intel, Verizon, AT&T. When you hear somebody talk about large cap growth stocks, you're thinking about Microsoft, Apple, Amazon, Facebook, Alphabet, Visa, United Healthcare. Typically value companies pay more dividends. Growth companies will pay dividends, but growth companies are more focused on getting bigger and growing. So if Netflix is a growth company, they're trying to get more subscribers and grow their business, where JP Morgan, a large bank, but not looking for putting new branches on every corner. When you think about international funds, you can think about Roche or Novartis or Toyota, HSBC. Nestle is an international company. So a lot of this is basically asset allocation means having a portion of your money in each sector. About 55% of the world's stocks are held in the US, are US companies, I should say. 45% are international. So typically you'll have a mix of large cap growth, large cap value, maybe some mid cap, maybe some small cap, international, emerging markets, and bonds. So bonds pretty much will provide the stability to your portfolio. So if you're an older investor and it's a retirement portfolio and you're taking money out and you don't want a lot of volatility, you may have more bonds. If you're young and aggressive and you're adding to your portfolio, you'll have more stocks. So what typically people do as they're building a portfolio and growing, they'll put money in there through their 401k or IRA each week or each month. And as you add to your portfolio and you buy on a systematic basis, it's called dollar cost averaging. So when the market is low, like it is right now with the pullback because of COVID-19, people are still adding to the portfolio in the 401k, and so they're buying at cheaper prices. When the sale goes on at the mall, people rush in and they buy. A lot of times when the sale goes on in the stock market, people tend to rush out the door. And so if you have a long-term view and you can manage the volatility, a lot of times having stocks will provide a higher return. So you want to diversify so you don't have all your money in one company. So if one company has problems, go down, but you may use mutual funds or ETFs to have a wide variety of companies inside a portfolio. The most important thing to remember is that your asset allocation. So when you're doing your planning and you say, I'm 80% stocks and 20% bonds, it helps you manage the emotion if you set your allocation from the start and understand that if the market goes down, you're not going to react and sell everything. If the market goes up, you're not going to keep buying more and more stocks because you're chasing after returns. Basically, when you do a plan, you want to set your allocation and it'll help you manage your emotion along the way. They say when the market goes up, people feel a certain amount of euphoria and they feel twice as bad when it goes down. Putting a plan in place, managing it, having cash on the side for your emergency fund. So if the market does go down and you have an issue, you have cash on the side. If you have your debts paid down or paid off, you're not worried about making payments. You can manage your risk a lot better and your emotions a lot better. So Setting up asset allocation, work with your financial planner, put it together, and stick to it. All right? Thanks.